In this video, we will go over each statistic and how to use it in your trading. Right, so the float is the total amount of shares that are available for us to trade. We consider a stock to have a low float if it has less than 20 million shares. Now, a low float means that the price movements can be very violent and volatile. For example, we're going to take a look at MRIN, which was a runner in the last couple of weeks. MRIN has a float of about 10 million shares. Notice how it goes from $2 to almost $30 in just a few days. And then it drops just as fast. This is the norm for a low float. They go up fast and they also drop fast. Institutional ownership is how much stock is owned by pension funds, mutual funds, and other investment firms. A high I/O, generally over 40%, means that the stock will move slowly. It will grind and grind. Generally speaking, however, large cap stocks like AMD, Microsoft, Facebook, etc. will have a high I/O and will behave differently than low float stocks with a high I/O. So it is important to know which combination of stocks you're trading. If you're trading a large cap stock with a high I/O, remember that it will behave and move differently than a low float stock with a high I/O. Insiders are your employees who own stock. We generally do not pay attention to insiders. Okay, let's go ahead and talk about float short. So what is a float short? A float short is how much of the overall float is being held as a short position by traders, institutions, etc. A high short float, which we define as 30% or more, can lead to the stock to have a short squeeze, like we've seen in GME, AMC, BBBY, and quite a few others lately. Short squeezes are violent and they can present a fantastic opportunity. As you can see in our chart here for AMC, this is more or less what you start to see with a short squeeze. At the time, AMC had a fairly high short float. All of those people that were holding onto a short position waited too long. They ended up covering higher for a loss, sending the stock higher, and it just became a vicious cycle. Average volume. So as a trader, we want to trade stocks that are active during the session. A quick glance at the average volume will tell you how much interest there is on a stock. For example, if you're planning on trading XYZ and you see that the average volume is 500,000, but on the day you notice that the volume somehow is 5 million, well, that means that there are a lot of people paying attention to the stock, so a move is more likely to happen. Okay, so in this section we're going to be moving towards the financial side of the platform. So these are the fundamentals of a company. We have cash and cash equivalents. Simply put, it is how much cash the company has in hand as of the filing date. Net cash used in operating activities is how much money it costs to run the company for the filing period. Monthly cash burn and months to live. We calculated these two statistics based on cash and cash equivalents and net cash used in operating activities. This is important because it shows you if a company will run out of cash soon or is out of cash right now, which can cause them to raise money by using any active shelves. When a company raises money, the stock price usually tanks. So if you're a short seller, finding companies that are out of cash or will be in a short amount of time and have an active shelf registration can give you a strong conviction of your short idea. Conversely, if you're a long trader, You will want to be careful longing these companies because they can do an offering at any moment, so you should not overstay your long position, or you should avoid it altogether. The next few statistics give you an idea of the health of the company, which can strengthen or weaken your trade thesis. Total current assets are company assets that can fund day-to-day operations, while total current liabilities are the combined debt the company owes. Current ratio. We divide the total current assets over total current liabilities. The higher the ratio, the healthier the company. A ratio that is less than 1 indicates an unhealthy company, meaning liabilities are greater than the assets. The net working capital. We subtract the total current liabilities from the total current assets, just another metric indicating the health of the company. The accumulated deficit. This is the difference between the company's cumulative profits and its losses. The higher the value, the less financially stable the company is. And now we arrive to the last set of statistics, which is shelf registrations. These are how companies can legally raise money. They are offerings, stock, options, etc., that the company puts out on the market, selling their stock at the higher prices to get an influx of cash. These usually result in the stock tanking from the current price. Active registrations combined with the month to live stat are a powerful combination to pay attention to, like we discussed in the previous section. Amount is how much the company can actually raise. This can be in dollars or shares, while the effect is essentially the date when they have permission from the SEC to raise money. If there is no effective date, it means that they have not been given permission by the SEC to raise that money yet. If there is an effective date, however, they can raise money at any time after the date. We will go through the different restrictions that can apply to shelf registrations on a later video. Thank you for watching. Make sure to smash the like button and subscribe. See you next time.